Greetings, partners. Welcome to this brief presentation, which I hope finds you well wherever you may be. And so today I'm going to discuss our recent performance and provide additional context for you. And so one of the benefits of being a data-driven firm is, of course, the fact that we have data. And here really I'm referencing trade data. So when you go live, you generate live trade data. And with that data and associated statistics, you can draw sensible conclusions, and with those conclusions, hopefully make rational decisions. And rationality is sort of the cornerstone of long-term trading success. And the reason for that is, of course, making and losing money cuts close to the bone. And we're all emotional, and it can be difficult to maintain rationality in those extreme instances. And there are many studies through time of, for example, successful funds that have generated 15 to 20% a year on average through time, but a close inspection of their investor base shows that the average client loses money. And the reason for that, of course, is that clients often become emotional during periods of losses or flat performance. And during those periods, they redeem or withdraw their funds. And then when performance looks good again, they reallocate, and essentially what they do is they buy high and sell low. And this is a bias that's strong, and it's one that we need to work to overcome. And so today I'm hoping to provide some additional insight to you that I believe will be helpful and useful. And so as far as our performance has been, over the last 6 months, for sure, it's been difficult. And so when you encounter these types of environments, it's important to ask questions and understand what is causing the performance to depart from expectations. And regardless of approach in the market, you will find that there are environments that are favorable to certain approaches, and there are environments that are less favorable. And if in analyzing your data, you find that you're in a favorable environment and performance is poor, that would be a concern. If instead you find yourself in an environment where it's less favorable and performance has fallen below expectations, then perhaps you'd be more comfortable with that. And so I've been asking quite a few questions from our recent trade data, and here specifically I'm referencing since the start of January through the end of June. And so my starting point here, because it's been a fairly consistent negative return stream, the starting point here was just to analyze our models in isolation, so the component part returns. And you'll see here I've got long overnight, short overnight, long intraday, and short intraday. We're missing momentum. I've excluded that because momentum for the year has been positive. It's been a positive contributor. The losses have arisen from our mean reversion allocations. And when you look at the component returns here, in any one strategy, you'll note that, yes, there are negative prints, but there have also been a bunch of positive prints. And so it hasn't all been negative. What's been unfortunate, of course, is that in any given month, there's been at least one instance of more severe losses that have overcome any gains that were observed in other models, and that's resulted in this negative stream of performance. So that's the first observation. Next, when you do look at the positive performance, the average return or the return for the month are quite muted. So we haven't seen a return really above 1% other than February. So very low positive return. So that's an observation I'd like to explore and why that is happening. The other is losses are more or less aligned with the gains, other than March, where we see a strong negative print, and in fact June. So we've got a strong negative print in March on our long overnight models. You recall the regional banking crisis, and then we've got a strong negative print in June for our short overnight models. And the question then becomes why? What is causing those losses? Because essentially it's these 2 months that explain the losses for the year. And so to help us understand the reasons for this, we'll start by just exploring volatility. And here I've got implied volatility and realized volatility. So implied volatility simply tracks the VIX index, which is well known in the US. It's a volatility index High levels would imply that there's uncertainty in the market and there's more volatility. Low levels, less uncertainty and less volatility. Realized volatility is essentially just the volatility that actually unfolded in the market. And what you'll note here is in both instances, volatility has fallen off a cliff. So it's contracted rapidly. In fact, it's sort of halved over a 6-month period. And if you are to measure that against historic contractions, this would rank quite highly. So it's extreme in nature. It's at least in the 5th percentile, probably less than that. And when volatility contracts like this, we know a couple of things. First, as it relates to mean reversion, our approach that we're discussing here, higher levels of volatility tend to favor us. And that's intuitive because the more volatility around, the more uncertainty, and the more likely market participants will behave irrationally. And it's that irrationality that we hope to capture and profit from. As the market becomes more complacent and more comfortable, market participants tend to behave more rationally. So higher levels of volatility tend to favor us, but not all high levels of volatility are the same. So you can have high levels of volatility that are stable. Those would be our sort of optimal conditions. But if you have high levels of volatility that are rising rapidly, that would still present a risk. But overall, we tend to be correlated with volatility. So in a crisis environment like financial crises, the dot-com bubble, COVID, we tend to observe much higher returns. Now, what happens when volatility contracts? We see the opposite. Two things happen. First, our models calibrate themselves by looking back in time. They don't attempt to predict the future. And so if you have an instance where volatility is falling, let's take this sort of extreme drop here, your models at this point are expecting volatility to continue at this level. And what happens is volatility actually contracts as you move forward in time. And so your models persistently remain somewhat out of whack with the market in the sense that their position sizes will be somewhat smaller because you're expecting higher levels of volatility to continue, and where you enter in the market and exit would be somewhat further than you ought to be. And the result of that is you tend to do less trading, so below average trading. And because volatility is falling, any trades you do, you expect to enjoy below average payoffs. And so we can go ahead and examine our live trading and see if this bears itself out in the data. So the first observation we've noted is that we expect trades to fall in the last 6 months. And here what we have is just a chart of long trades for all our mean reversion models. And these are the average completed trades in a given year since 2002. You can see typically we tend to complete an average of about 120,000 trades in any given year. And that's really kind of robust through time. We get spikes in volatility, dot-com, we've got financial crisis where we see above average, contractions in volatility, see below average, expansion, see above average. But what you'll note this year is that we're halfway through the year and we're sitting way below average. In fact, if we assume the rate of trades being completed will continue in the same manner going forward for the rest of the year, we're probably going to end up with a number of trades completed somewhere around here, which is half than the average. And in fact would be the lowest number of trades we've completed in any given year. The only other year that resembles this type of trade count is 2009. And the similarities are quite clear there. We had the 2008 crisis where volatility was very extreme and then it contracted rapidly. And we saw that pattern unfold. So here we had the sort of COVID crisis where we had volatility very extreme and we've seen it contract and we're seeing below average trade counts. So that's on the long side. If we look at short trades, we see the same pattern. So here again, we've got our average. We get these explosions in volatility where we see above average. But this year has certainly been a year where we've seen below average trade counts. So this is contributing factor number one to our performance, at least the positive months, sort of being muted here. We're just not doing anywhere near the same number of trades or anywhere near the average number of trades that we expect. We can explain that because we observed a very strong contraction in volatility. So our performance likewise tends to mean revert. We have periods where things go really well, and there'll be some of you that were, many of you, in fact, that were part of the platform during COVID, and there many clients did returns of over 100%, in fact, even some over 200%. So we had the good times, and now we've had this contraction, and that's not unexpected, and the data bears this out. So we've got a handle on trade counts. Now, the next data point I want to look at is average price move of each trade through time. So the average trade moves approximately 1% in our favor over time. And you can see the crises, dot-com, COVID, 2008 financial crisis, COVID, and then we've got a sort of striking print on the end here, which is a negative average price move for 2023. And the reason for that is, of course, we had the regional banking crisis where we were caught in a couple of shares that went to zero. So essentially, we lost 100%. And when you divide that 100% by the below average number of trades we've completed this year, you get an average negative price move. And so it was those events that explain the negative print here. And if we remove those, then we tend to see average price move more in line with the sort of low volatility years. So this would be another contributing factor, and we'll have a look at why that is in a minute. So the next is our short trades. And interestingly here, we've also seen below average price moves so far this year. Now we know the longs, we've spoken about the longs in the past, we had the regional banking crisis, but the shorts we haven't discussed. So the question then becomes why? Why are we seeing below average price moves in our short models as well? We know that volatility is contracted, but in 2009 and even other very low volatility years, 2019 was probably the lowest vol year on record. We're seeing sort of higher average trade price moves. So what is causing that? So one interesting way to analyze the data is to look for what I call tail prevalence. Now, a tail, just in layman's terms, is a trade that moves excessively against you. And in this instance, I described it as a move of negative 10% or more. So you can see through the crises, we tend to expect more tails. So dot-com, 08, we had some volatility here, we had COVID, but 2023 has set a new record. So we've seen the greatest number of trades that moved negative 10% or more against us in 2023. And we know that indeed is the result of the regional banking crisis, where we were caught in a number of stocks that moved excessively against us. Now, we're actually not too concerned about tail events because typically they occur during a market environment that sees very high levels of volatility and lots of order flow. In other words, lots of opportunity and big payoffs from the order flow. So dot-com would be an example of 2008, and so would COVID. This is extremely unique in the sense that volatility has contracted very, very rapidly, but it's also been associated with extremely high tail events. And this is not an environment that models have encountered in the past. And in fact, it's not an environment we'd expect to do well in, because we're seeing extremely difficult trades for us, dangerous trades, but they're coming without the associated volatility and order flow and payoffs that we'd expect from these high volatility environments, because it's essentially a low volatility environment. Now, what's interesting though is if we look at the short trades, we see tail prevalence at a high as well. So we know 2020 was pretty extreme. If you recall, we had the meme stock tail events, AMC, GME, there were a lot in there. The other sort of high vol environments, we saw tail events, but 2023 again has seen a very high rate of trades move 10% or more against us. And the reason for that is, of course, the AI boom. This has been an innovation in the market that one could draw comparisons with the internet and possibly even stronger. And so there have been some very, very strong moves on the short end against us. And again, this has come off the back of very low levels of volatility and order flow. And it's this combination of doing below average trade counts, any trades we do, enjoying below average, or rather seeing below average trade payoffs. And all of that is being mixed in with an increase in the number of extreme trades against us. And so this would almost be our sort of worst type of trade environment. And this is what explains the difficulty we've encountered so far this year. And so we'll talk a little bit about how we react to this going forward and how we continue. So before we get to that, just a couple of other trade stats that I've looked at. This is the average win rate through time. You can see it's actually really robust. We have a win rate of it's about 60%. The y-axis doesn't clearly communicate that. It's about 60%, very robust, below average this year. Again, the tail events would have affected that. Short trades also really quite robust. Again, we have a win rate of about 60%. This year's better. We've seen the tail events not as extreme, and on average, shorts have been still profitable this year, but still slightly below average. And then the holding period, more or less the same through time, quite robust. It's extended here because some of the trades we were caught in, these are just calendar days, were suspended for a couple of weeks and then started trading again. These were some of the regional banks, so that would have biased that, but it pretty much in line. And then short trades, again, almost perfectly in line. So there are a lot of other stats here that we monitor and watch. And by all accounts, once we factor in the lower volatility and the tail events on both the long and short side, everything at this stage appears to remain within what we would expect given the context of the market. And so how do we respond to this going through time? So the summary here is that the fund through the last 6 months has seen below average trade counts. That's a result of falling volatility. We've also seen below average trade payoffs. Again, that's a result of falling volatility. But in addition to all that, we've seen above average extreme losses, which we can explain through the regional banking crisis and the AI boom. So it's been a difficult environment. But the important point to keep in mind here is that all the data we've discussed today likewise have strong mean reversion tendencies. So with the market at essentially, all-time lows in terms of volatility, or at least getting very close to that, and with price looking somewhat toppy at this time, we'd expect at some future point that these would reverse. So we don't expect tail events to continue indefinitely in time. They appear and then you tend to see a reversion. And it's quite intuitive if you contemplate it. A stock that moves excessively against us would have had to have done so before entry consideration. So it's moved 20% against you, and then you enter and it moves another 10 or 20% against you. It's now lost 40%. When it starts another leg down, it's unlikely it could see another 40% loss. But eventually, when you take a cross-sectional view of the market, these trends tend to run out of steam. So we can see these big legs up and big legs down, and they can persist to some extent, but eventually they run out of steam. And you start to see a reversion in the data. And that's important to keep in mind, because our action plan going forward, at least at this stage, is to stay the course. The data, at least at this point, points to a trough, or at least performance getting closer and closer to a turning point in these data, which then would result in more favorable conditions for us. But of course, the market can do and will do what the market wants to do. And so we keep monitoring these conditions. And if we observe that they persist for longer than we expect, then it becomes a simple process of recalibrating the models for more extreme conditions, or rather the new normal. And that would be an environment where volatility is low and sprinkled with many more tails than we expect. And when do we do that? Well, at this stage, we as a group, would probably want to see the models run out the next 3 to 6 months and hope to find a glimmer of hope in that data. And if performance continues to persist against us, then at that point, we would make some changes. But for the time being, I think overall it's just been a very difficult run in terms of the conditions that the models have been presented. We do note in the past that after really good runs, we tend to see this sort of mean reversion in our own performance. And I think for the most part, we've come off an exceptionally good run. Some of you have not formed part of that prior to the fund, and now we're living through our own period of mean reversion. So I hope that provides some insight into recent performance in your fund. We continue to track everything. If you'd like to set up a meeting to discuss any of this data with us, please feel free to do so. Until our next communication, I hope you remain well, and we'll chat to you soon. Cheers for now.